Hello, this is Adrian Day with another of our video highlights. If you'd like to learn more about the topic that we discussed today, you can watch the full interviews on our website at adriandayassetmanagement.com, where of course you can also find more information about our services. Sit back and I hope you enjoy. Thank you.
All the reasons that people have been buying gold for the last 3 years. Central banks wanting to diversify their assets away from the dollar in the face of dollar weaponization. Chinese non-official Chinese investors concerned about the devaluation of the yuan and the stability of their banking system buying gold. Big wealthy investors in the Middle East and Asia particularly, but also in the US, people like Dalio and Jamie Dimon, people buying gold because they're concerned about the fiscal deficit. None of that has gone away. None of that's gone away. And Trump didn't cause any of those problems, but I think it's, at the very minimum, it's fair to say he hasn't diminished their impact.
To most within this space that there is a similar disconnect between the gold price and the value of the miners or the value of the mining equities. So where do you think that disconnect comes from?
Well, Tom, I think it comes from exactly what I was talking about earlier, but the drivers of gold for the last 3 years have not been economic drivers.
A typical North American investor buys gold, and by gold I'm now talking about gold assets, generally, when the economic environment is right, when the economy is slowing, because you think that means the Fed will start cutting rates, when inflation is high and increasing, when rates are low and being cut, and when the dollar's falling. So that's the perfect economic environment to be looking at gold. And that's the precise opposite of what we've had for the past several years. So it's no surprise to me, it's not illogical, let's say, it's not illogical that most North American investors have not been...
The price of gold moves up and the margins are expanding dramatically because the costs of mining haven't gone up anywhere near as much as the price of gold in the last 3 years. Well, then your cash flows are expanding. And if your cash flows are moving up faster than the price of a stock is moving up, your price to cash flow metrics are lower today than they were a year ago. And so the gold stocks today are actually cheaper. They're more undervalued today than they were a year ago. We talked about gold a lot, but I think it's important for people to realize, appreciate, but even though the gold stocks, if you look at the GDX or the XAU, even though the gold stocks are up 55% in the last 12 months, they are still remarkably undervalued. And, Oscar Wilde said, there are people who know the price of everything and the value of nothing. The price has gone up a lot, yes, but that doesn't mean that you've missed the bull market at all, because the valuation metrics are really low. Let me just give you an example. When the price of gold moves up, the NAV of a company moves up, right? It's not static. When the margins expand, when the price of gold goes up much more rapidly than the cost of mining, and the margins expand, and you've got gold at 33, over 3,300, and your all-in sustaining costs is 1,300, is up from 1,200, big whoop. It's gone from 1,200 to 1,300, but the gold price has gone from 1,800 to 33. You've now got $1,000 margin instead of whatever that was I said before.
Margin,
And so the cash flow metric, the cash flow's gone up. So the price to cash flow has gone down. The price to net asset value has gone down, even though the stock price has gone up. Most people think that the senior royalty companies are overvalued. They look at how much the stock prices have gone up and they think they're overvalued. The truth is, if you look at, say, Franco, which is one of my favorites, and compare it with the price of Agnico, it hasn't gone up as much as Agnico. But nonetheless, you just look at the thing, $169 a share. Oh, my goodness. That was meant to be gosh. Sorry. Oh, my gosh, $169 a share. That's expensive. Again, price, not value. Now, if you look at the valuations of Franco and Wheaton, Absolutely. If Ben Graham were alive today and opened his Bloomberg, if he used one, he would run away from those valuations, right? 5 times book, 70 times earnings. He'd run away. He wouldn't walk away. Mm-hmm. But the reality is that if you look at the valuations of the royalty companies today relative to their historical valuations, they're just average. They're not high at all. I'm not pretending they're dirt cheap, but they're only average valuations. And I think the business model plus the historical execution justifies high multiples, to be honest.